Yo guys, Leggy here and welcome to another week where we're going to be going through our stock portfolio. And it's been a wild week with the volatility index actually being at its highest point since the COVID crash in 2021. Now, this week has been really interesting. We've seen some huge drops. But I actually thought that I was going to have to go into this update a lot worse off than we actually are. Today we saw a slight rise in our investments. Is this because people are starting to get ready for the future? Is confidence coming back? And will this be a sustained rise? No, I don't personally think so. I think that, once everything settles out, we see more negotiations. I think people are hopeful of countries starting to negotiate deals with Trump. But I think that China's going to hit back harder, especially with the new tariffs in place on them. And I think that uncertainty is going to carry on throughout this year. So I think that this is a small relief in what will be maybe another Delta Cat bounce. Obviously, I'm not a financial advisor, and also what anyone says on this app, they can get completely wrong. And I'm no different. And to be honest with you, I'm preparing for both directions. I'm sticking with a good cash position, which I'm sticking up here in our cash ISA, and I'm just moving a certain amount aside every month. So we're investing £20 a month in dollar cost averaging. I'm actually interested to see how many days it will take for us to recover from this crash, even though I don't think we've subsided the crash yet, and I think that we've got more downside to go. I do still think it's quite a good buying opportunity, which is why I'm going to dollar cost average and hope for the long term. Obviously, like I said in yesterday's video, I think that there is a slight difference in this compared to recent historical events, in the fact that this might change how countries interact with each other and how trade is done in the future. So it could have a much longer lasting effect. So if we look at the day on our portfolio, we're up about £170, which I thought that I was going to have to come into this portfolio and say that, this week had been absolutely terrible. But it hasn't actually been that bad. With our weekly outlook, we're only down £285. I think that is an absolute win given the circumstances. With our 3-month outlook looking quite similar at £265 down. I mean, not ideal. No one ever wants to be red in the stock market because obviously that's not what we're here to do. We don't want to be here to lose money. We're here to make money. But as I said, we obviously sold our holdings in November, and I do feel like one of the few lucky ones around here to be actually overall plus £2,450-ish. Now, like I've described before, am I a magician who expected the market to crash? No, not at all. I just luckily needed to free up some cash for an emergency fund. So I liquidated my holdings with the intention to go back in for the long term and restart my portfolio. And it's just sort of worked out for the best for me, really. So we're trying to take advantage of this opportunity. Luckily, I'm also an investor, which has time on my side. Obviously, I'm only 25, which means that time is on my side, and I've got a lot of time to recover from whatever the effects of the market happens. This means that I can withstand a few years of stalling economic growth and poor stock performance if that is a worst case scenario. So if I think that the market's going to drop in the long term, why aren't I waiting to enter the market? Well, in my opinion, there's just no point trying to time the market because no one knows when it's going to bottom, and it could be a quick reversal. Not to say that it will be, but that is obviously a possibility we have to account for, which is why I don't think it's worth just trying to time a market. With that being said, let's look at our individual holdings. Firstly, we're going to look at SP 500, which we're down about 4.35% on. As I said, I've seen many YouTubers out there who are about minus 15%. Luckily, we brought when the S&P 500 had already dropped to about 90, and we've been dollar cost averaging in there with the intention of bringing our average down. I'm not concerned for the long run of this. Obviously, I do think it's going to be a longer recovery than people are saying, but I think we should be fortunate that we're only 4.35% down. And if we do see another free fall in the market, I will be prepared to buy in. I've got a little bit more to lump sum, and I'm prepared to. Otherwise, I'll go to dollar cost average. I've got certain amounts, and I think I've got about £1,000 I'm happy to part with before just continuing our dollar cost average strategy. As I said, I think that this would have to be quite a large drop in the market, and I'm not actively going to go and search and drop that £1,000 in. It's just literally if we see another massive drop, I will do it. Let's now have a look at our long-term pie where we've got the FTSE All World. Now, obviously, I've spoken about this before, but the FTSE All World and the S&P 500 overlap a lot, so it's a bit pointless holding both. Now, I made this decision a little bit earlier on in my investing. Now I'm just sort of sticking with it. Would I advise to someone new investing in it? Probably not. If I stuck to other things, I'd probably just stick to the other three pies we hold. But I still like having exposure to Berkshire Hathaway and Reality Income, which is also in this pie here. Now, FTSE All World, we're down 4.88%. Again, I'm not worried about this. Yes, it is American heavy. Between these two pies, we are quite American heavy. Berkshire Hathaway, we are also down 2.14%. We were actually performing quite well in this stock last week. They're holding a lot of cash, and they have been able to withstand the market compared to other stocks, and I think this is due to their high cash holding. Finally, this one's been hit the hardest. It was doing okay, but now it seems like it's not a safe haven for investors anymore, and that's Reality Income, down at 7.3%. Now, again, I'm happy with this opportunity. I'll go into dollar cost average into Reality Income. I think it's a high quality dividend stock, and it's going to be enabled to us to drip feed back into the rest of our portfolio when we build a sufficient amount. I mean, as you can see, we've only got £563 in it, which isn't a lot, but hopefully we can use this opportunity to build up a lot more so we get a higher monthly dividend. So now let's look into other. So basically I said that before it crashed, I wanted to increase my risk with my portfolio because I said I'm only 25. I've got the time to go risky, especially for the next 5 years. I think until I'm 30, I'm going to, have that slight bit of risk, and then we'll reevaluate it then. That made me look into a private equity fund because I did have an old pie in one of my videos where basically I was invested in a lot of the companies which are within this pie anyway. This one's down 3.82%, and this pie was started after the first two pies, and hence the lower percentage. It's not a representation of any of the stocks within this pie doing better than the S&P 500 over the last 3 months. It's just we started this one slightly later and therefore have a slightly better average. We got JP Morgan Growth and Income, which were actually 1.24%, and as I said, this is just luck of timing to try and catch the current bottom. Not to say that it will be the bottom of the stock, but a bit like Reality Income, this one is a way of just getting that frequent income into our portfolio, which down the line, when we get a bigger holding and we get a bigger dividend when they pay out, we can just drip feed into the rest of our portfolio. Now we've got physical gold, and this one's a bit of a weird one. Obviously, it's up quite a bit over the last three months, but within the last few weeks, it's actually dropped a little bit from our average price. This is not normal because gold is normally seen as a safe haven for investors when we're in times like this, but we are slightly down on gold. But like I said, it's got a small allocation within our portfolio, so I'm not worried at all. Also, we've got bonds, like I said, slightly down on this as well, both just about 1% between this and gold, but we're just going to slowly invest. Like I said, I'm at an age where investing in bonds and their returns is not the most attractive to an investor of my age due to wanting more growth. But I do think that it's important to have it in there as a bit of a diversified portfolio, albeit only a very small amount within our portfolio. So the final one we're going to look at is our rest of world pie, and this is mostly because, as I said, between our long term and VUSA it's a bit too much exposure to the United States at this time. I do think the rest of the world might diverge from America in the long term. But what we could see is a long-term shift in how the world works. This is why we've got this rest of the world pie, as it's got a selection of stocks from the overall parts of the world. Now, Japan and India have managed to recover slightly and they're slightly up, but I don't think this will be a sustained period of it being up. I think we just managed to buy into them quite low after they crashed. Whereas if we look at our China stocks and our European and UK stocks, they seem quite heavily hit at the moment. I can't imagine the China stock's going to be good anytime soon, especially if this trade war escalates between China and America. But obviously, we've got cash to deploy. We've got £980 in our account, and we're going to dollar cost average £20 a day. It'll be interesting to see where we are in about 18 months and stuff, because really, in the short term, anything could happen. It could crash way more tomorrow. The market's really dependent on news of how negotiations go, how China continue to react to America, if any other countries respond to Trump's tariffs, because overall there's been rumors of an overall positive response and a lot of countries trying to run to make deals with America. But there's been obviously not many public announcements, there's been not a lot of public talk. So really that should clear up a lot in the coming months or next year. And then we'll really see an overall view of where the market is. Overall, we're sort of in a bit of a bad position in our portfolio, being down. As I said, it's not a good position to find yourself, but I'm optimistic for the long view, and compared to a lot of other investors out there, we're doing okay. But with that, guys, I hope you guys did enjoy this video, and peace.